Okay, we need to talk about foreign currencies and the consolidation of foreign subsidiaries. We're going to have numerous occasions where we need to convert from a foreign currency to US dollars or vice versa. We may buy goods from an overseas vendor, the invoice expressed in the foreign currency, and we need to know how many US dollars that equates to. We may have a foreign subsidiary where the trial balance of the foreign subsidiary is kept in a foreign currency, and we'll need to convert that to US dollars before we can import that information into our consolidation process. To make this conversion, we're going to need to use an exchange rate, which shows the relative or proportional value between two currencies. An exchange rate can be given either as a direct exchange rate or as an indirect exchange rate. The direct exchange rate is the dollars per foreign currency unit. For example, saying the British pound is worth $1.48 is an example of a direct exchange rate. To make this a little bit more confusing, the direct exchange rate is often written, in the case of the British pound, as GBP/USD, or without the slash, GBP/USD. Now for my part, when I see GBP/USD, my inclination is to interpret that as British pounds per US dollar. That is not the case though. Again, this is British pounds expressed in US dollars. The inverse of the direct exchange rate is the indirect exchange rate. It's the foreign currency units per dollar. For example, the Japanese yen is quoted today at about 120 yen to the dollar. The indirect exchange rate is written as USD JPY or USD/JPY. Again, you can interpret this as the US dollar expressed in terms of the Japanese yen. Here are some exchange rates from, as of the end of the day, March 26th, 2015, and you can see that different currency pairs, some are expressed as direct exchange rates, others as indirect exchange rates. This is from the finance.yahoo.com website. Yahoo is a U.S. corporation, so my inclination is to think of these from the perspective of the United States. So the first one, the euro/USD, that's an example of a direct exchange rate. The euro is $1.0865 per euro. Similarly, the Australian dollar is expressed as a direct exchange rate. The Australian dollar is worth about 78 cents. Likewise for the British pound is worth about $1.48 US. The next rate, the Japanese yen rate, is expressed as an indirect rate. Again, in this case, it's 119.2 yen per US dollar. Skipping over the two non-US exchange rates, we see also that the Canadian dollar is also expressed as an indirect exchange rate. So it's $1.24 or about $1.25 Canadian per US dollar. If that had been expressed as a direct exchange rate, that means that the Canadian dollar is worth about 80 cents US. Now, in many cases, it's clear what the exchange rate indicates. For example, the British pound has always been worth more than $1. So if you see the British pound quoted at $1.50, you realize that's the direct exchange rate. Similarly, the Japanese yen has always been worth, a penny, or sometimes, historically, substantially less than a penny. So when you see exchange rate given as 120, you realize that's an indirect exchange rate. The problem arises when you've got currency pairs that are approaching parity. The best example here of these 6 or 7 currency pairs is the last one, the US dollar/Swiss franc. If somebody simply said the Swiss franc rate is 0.9643, that's close to parity, that's close to a 1-to-1 exchange rate, and it's not clear, without looking at it and thinking about it for a moment, it's not clear whether that's 96 cents per Swiss franc or 0.96 Swiss francs per US dollar. In this case, this is an indirect exchange rate, which means that it's 0.96 Swiss francs per US dollar. Now, if we have a foreign subsidiary, we're going to need to convert their accounts and their trial balance from whatever foreign currency they're kept in to the US dollar. Again, this is all being approached from the perspective of a US corporation which is going to be consolidating their foreign subsidiaries. So our reporting currency is the US dollar. That's what we need to have everything measured in US dollars. If we keep our books in dollars and our subsidiary keeps theirs in yen or euros or Swiss francs or British pounds, we can't simply add dollars plus yen. They're apples and oranges. They're different measurement units. So everything has to be expressed in the same currency. And again, since we're a US corporation, we're going to assume everything needs to be expressed in US dollars. This conversion is referred to either as remeasurement or as translation. The difference between the two is based on the idea of the functional currency. The functional currency is the currency of the main economic environment within which the subsidiary or within which the entity operates. Rather than going into that in detail here, I would suggest that you simply Google the term functional currency or whatever search engine you prefer, and you'll find hits immediately with long discussions of what constitutes the functional currency and how to determine it. Now, for example, if we own a majority of a Swedish automaker which builds cars in Sweden and sells them throughout the world, the functional currency is probably going to be the Swedish kroner. They incur expenses and generate cash flows in that currency. On the other hand, if we own a manufacturing plant in Mexico and we ship raw materials and components over the border into Mexico, get them assembled into finished goods at a lower labor cost, and then ship them back into the US for sale or distribution, then the functional currency might be the US dollar. In the majority of the cases, corporations are going to be dealing with cases where the functional currency is the local currency, and so we're going to be dealing with cases of translation instead. If the functional currency is the foreign currency, and again this is the most common situation, then we translate from the local currency to the US dollar. If the local currency is not the functional currency, then we remeasure from the local currency to the functional currency. So putting this sort of a diagram, if the local currency is the peso, again thinking of the manufacturing facility over the border in Mexico, if the local currency is the peso and yet the functional currency is the US dollar, we remeasure the trial balance from pesos into the US dollar. On the other hand, if the functional currency is the euro, again, for example, if we own a majority stake in a German manufacturing company, and the functional currency of that German manufacturing company is the euro, when we want to take their trial balance and convert it to dollars, we will be translating it instead. Finally, you could have a complicated case where, let's say that we have a manufacturing plant in Mexico. The local currency is the peso. They import their goods from Europe and then export them to Europe, so their functional currency is the euro, and the European company is our subsidiary, so we need to put it into dollars. In that case, first we would remeasure from the peso to the functional currency, and then we would translate from the euro to the US dollar. Now, remeasurement and translation differ in two ways. First is going to be the choice of exchange rates. When we convert from the foreign currency to the US dollar, we're going to apply different exchange rates to different financial statement elements. Assets might get one rate, equity accounts a different rate, revenues accounts and yet a third rate. For example, we might use the current exchange rate versus the average rate over the course of the year versus some previous historical rate. Depending upon whether we are remeasuring or translating, we're going to use a different set of exchange rates for the different financial statement elements. When we convert a trial balance that balances in euros, for example, to one measured in dollars, if we use different exchange rates for different financial statement elements, it's almost guaranteed that the resulting dollar-denominated trial balance isn't going to balance any longer. We're going to force it to balance by adding a new account called translation or remeasurement gain or loss. The second difference between remeasurement and translation is what do we do with the gain or loss on remeasurement or translation. Under remeasurement, the gain or loss, the remeasurement gain or loss, is treated like a regular gain or loss in the subsidiary's dollar-denominated income statement, just as it would be if it was a gain or loss on sale of some asset. This is very convenient because that remeasurement gain or loss gets closed to income summary, it gets closed to income, and we never see it again until we do the process the following year. Under translation, that translation gain or loss is part of other comprehensive income, and instead of getting closed out to income summary and thence to retained earnings, it goes to the balance sheet as part of other comprehensive income. So it gets a little bit more complicated because these translation gains or losses get carried forward from one year to the next.